I'm back. I'm a partner at venture capital firm Hash. We've been investing in early stage for about 7 years. We have a group of pure venture fund managers. We'll be talking about some of the latest topics with the early stage venture and also on DPI, as a lot of people are interested in how early stage exits have been going. And also we'll touch a bit on the future prospects around 2025 on how we see as early stage venture opportunities. Why don't we start with the early quick intros? Joe?
Hey everyone, Joe Berzesi. I'm a general partner at RW3 Ventures. It's a fund we launched coming up on 3 years in January. RW3 was built in partnership with the Raptor Group, which is the family office of Jim Pilata. We're backed by Mubadala, and prior to this, we helped build some of the biggest companies in the crypto space, including BitGo and Zappo.
Hey, Mike Buccella, co-founder of Neoclassic Capital. We're a relatively new venture fund, so no DPI to speak of yet with this firm. I previously was a partner at a firm called Block Tower. We did venture and hedge fund investing and did a ton of privates where we managed the liquidity of those assets going public. So I'll probably be mostly referencing the 2017 to 22 cycle.
Hey, my name is Suna Amaz, and I'm managing partner at Volt Capital. We are a super early stage, focusing primarily on pre-seed and seed within digital assets and crypto. We've been in a lot of breakouts, like some of the earliest checks into Layer Zero, Nansen, Magic Eden, Third Web, and other category leaders, Farcaster as well. And prior to that, started a company that's now post-Series B, and before that was in the big data AI dark ages at a startup that's now about $2 billion worth in pre-IPO. So I come at it from the operator's perspective and then started our fund so that we could help operators build their businesses from 0 to 1.
Awesome. When we got started in venture investing in crypto, I think most of the funds portfolio composition was quite similar. It was the early days of white paper investing. A lot of them are investing in ICOs or layer ones. But now I see a lot of the new funds start to have completely different composition between different funds. So I guess first to kind of start with the high level division, what's your composition and how you look at equity versus token investment within your funds? Maybe starting from Suna? Yeah.
Sure. So the industry's largely coalesced around at least the pre-seed seed stages, is a safe with a token warrant. There's that is about 95% of all companies are going out to market are raising on that structure. And then within our fund, that is largely what we're investing in. We're venture capitalists. That's our edge. That's our expertise. And then in terms of liquid positions, we do give our LPs exposure to the larger coins. Like we do a Bitcoin, Ethereum, Solana exposure, but we believe that most of our LPs are sophisticated enough to get exposure anyway. So that's not our focus as a fund.
Yeah, I would say we focus on early stage, basically anywhere that value will accrue. So I think, again, you've said we've all kind of coalesced around equity with token warrants. Our firm, we focus on the token space. We want any and all deals we look at to have some token component, some value accrual to a tokenized asset, simply because the benefit of crypto venture is a much quicker liquidity cycle. You don't deal with the gatekeepers of Goldman Sachs and Morgan Stanley determining you're worthy of an IPO and then working through an order book. It's managing relationships with market makers, exchanges, your projects, their networks, their communities, a future holder base, and getting liquidity. Because ultimately our job is to make our investors money and give it back to them, and then they decide to give it back to us or not. So that's how we think of it. I mean, yeah, we've done equity and token warrants. We've done pure SAFs. Actually, we do a lot overseas, a lot in Asia, Japan, Korea, Singapore. SAFs are actually still relatively popular there. We'll always kind of push for protective measures in our contracts. So if value accrues elsewhere or there is a liquidity event on the equity, you can put in these clauses that allow you to maintain exposure and reduce your liability of not having exposure to where value accrues. But again, tokens are the key to what we do in crypto venture.
I think we take a bit of a different approach. We kind of have a barbell strategy where we're definitely in early stage crypto deals where the expectation is the liquidity is going to come from tokens in the long run. I think on the contrarian side, We think that there's a lot of businesses where there are real world use cases of blockchain technology where value is going to accrue to equity, where there's going to be real revenues and real businesses built. And so we have a whole other side of our portfolio, which is longer term investing in companies that we think are going to use blockchain to disrupt big incumbents in really large addressable markets. And so we've spent actually a lot of time putting together a portfolio of equity focused investments that we think will do very well long run. And I think what you see what just happened with, Bridge and Stripe, for example, I think is kind of a big inflection point for what's coming, for equity focused businesses.
You just got to be a Sequoia portfolio company. I think that's the key.
With regards to value accrual on the equity or token side, it is an excellent, I think, point to take a step back and think about equity vesting schedules to begin with. So these are typically 1-year cliff, 3-year vest. That 4-year timeline was conceived of during a time when companies would start an IPO within a 4 to 5 year timescale. Like, we have not seen that. Typically, companies, because of the overhead that comes with IPOing and underwriting the IPO, you're seeing companies stay private for 10 to 14 years. And you look across every asset, across AI, social, fintech, and try to find any asset that has a reasonable path to liquidity within a reasonable time frame. And the only ones that we can point to in venture truly that fit that 4 to 5 year model is crypto. And so it is going to be the major DPI driver for LPs, and everything is downstream of that. GPs being able to raise their funds, and then net new narratives and categories being funded on the operator and company level.
Yeah, definitely. As Joe mentioned, last month's Bridge's exit to Stripe was quite a positive sentiment news on potential consolidation of certain equity exits of venture portfolios. But as a venture investor myself, and we have quite significant amount of equity investment, but I noticed that some of the common challenges with equity companies that don't have token, or that, as Suna mentioned, these equity companies take years to mature, and especially in a frontier technology like crypto, to build a recurring like ARR, it takes a longer time, it seems, as there's not many defined customer set or buyers. So a lot of them have hard time raising around Series A and B beyond, because they can raise seed with the vision, but when the market is not there yet, they struggle to raise and maybe run out of balance. How do you approach this kind of a runway or potential kind of exit scenario with equity companies within your portfolio, maybe Joe?
I don't necessarily know that the past trends are indicative of what's coming in the future. I think that there's been a huge focus on tokens, especially if you look at what happened from, call it 2018 to 2021. Many of the best performing venture funds were in a lot of the same names, Solana, Avalanche, those core infrastructure plays. But I think now that the infrastructure has matured, it's attracted very, very great builders to the space. I can say from our portfolio, we're very confident we have some of the best entrepreneurs that have ever entered into Web3 in really the last few years. And so I think that what you're going to see happen is, as people build products that have much bigger TAMs than it's ever existed in the space, as I said earlier, we were some of the key people behind BitGo and Zappo. One of the things I've seen in what I call crypto for crypto companies is the TAM just isn't that big. A lot of the original equity businesses were built to sell to other crypto companies. What they find is they can get a lot of customers early in the journey, but they start bumping into the size of the addressable market. I think as people build real world applications, the TAMs are much larger. And so what you're going to see over the next 5 to 10 years is people are going to build really interesting products on top of blockchain technology that serve markets that are much bigger than just crypto. And they're going to be able to raise much and much bigger rounds than what we've ever seen.
I think that's very well said. And from an equity standpoint, that's exactly right. I think the crypto to crypto sales process, there's just not a large enough market. I think it's the projects that have capabilities to go beyond our industry into traditional financial markets. And I think the more stable coins, for example, are adopted by the rest of the world and are in a way regulated, that's where you get into truly other businesses, other business lines, other sectors. On the token side, it's our own fault. I mean, we give way too much leeway to companies on valuations. If you're a seed crypto company, valuations have skewed from being a 10 million seed in 2019 and 2020 to your average being 40 to 50. We have to be tougher on valuations, let them use their tokens to incentivize their network. If they can't incentivize their network with their own, whatever their token economics are, their incentive models are, it's probably not going to work, and they don't deserve a Series A or Series B. That's my take. I mean, some things do take longer. I think people that have been working at RWA for a very long time, I commend them, and they deserve to continue to be funded. Maybe not at substantially higher valuations, but I want to see those proliferate. I'm a huge, huge believer in RWA, which is on-chain finance, basically bringing real-world assets on-chain. But we need to originate them on-chain. There's a lot of hurdles before we get there, but I think it's a J curve. So I wouldn't be willing to finance them at a much higher valuation, but I'd be willing to keep them alive until that time comes.
Yeah, I think we're already starting to see a lot of these crypto built for the masses. Maybe it's a little bit contrarian. It's not only within the confines. Obviously, one of the glaring examples is Polymarket, but then also Polymarket's authentication system, which we're an investor in. Like, the way you log into Polymarket is actually also a crypto company called Magic, and they service everybody from Intel and Macy's to AngelList to Polymarket and all these other leading crypto and Web3 companies. So I would say that we're actually already seeing that. But the initial question Bake was asking was, like, what's the framework that you use when you're evaluating these exits as you're looking at the Series A or Series B when they get there? Because there's one thing to sell a vision, and then there's another thing to actually ship the product and have that meet what your investors thought you were shipping. And there's a few, it's highly contextual is the answer, and there's a general framework you can use. One, the founder's execution ability. Are they executing and crushing the milestones that they said that they were going to hit by the time they said they were going to hit them? Two, where are we in the actual crypto cycle? So there's a couple things going on in crypto that are unique to crypto in that, unlike traditional markets, we have to be more sensitive to the cyclical nature of the crypto space. And so understanding where you are, not only from a vertical or narrative perspective, but then also in the crypto cycle is extremely important. And then the last piece is, are they writing a narrative that's going to have multi-cycle longevity? And then you take those into account, and then you have to, and this is what our LPs are paying us to do, is to weigh the growth potential across against the premium offers we're getting from potential buyers. And that's the framework you typically are using when you're deciding whether or not to exit a position. But again, very highly contextual.
Awesome, thank you, Suna. I guess on the other side, on the token investment, I think generally early stage funds are quite good at accessing, unique deals early enough that there's a multiple, which is unrealized gains. But the exit part of token is a form of art. And I think every fund has a very different approach and framework to it. I'm curious, in each of your funds, is there certain key parameters you guys look out for or track that signals that this could be a good timeline or good range of exit for your portfolios? And I think this is quite a big topic for the whole industry so far, that because venture funds tend to own anywhere from 0.5% all the way to more than 5% of the network. And it's a big question asked by limited partners as well on how you realize to deliver the DPI, which is the topic of the panel, but also by the community and crypto Twitter on when is this fund going to actually exit the significant amount of token they own of the network. So curious, how you guys approach in your own funds.
Sure. I mean, this is why I always say early stage venture in crypto is a labor of love. I think you need to have a smaller pool of capital that's agile. And when you do knock one out of the park, it all comes down to liquidity. And that doesn't mean you sit there and wait for it. That means you create it in certain instances. I mean, a large part of what we do as investors is, yes, we try and ensure that our projects and companies and founders are on a good trajectory, but you need to help them understand what the value accrual typically comes to. So, you help them understand what market making is. You help them understand what exchange listings look like. You help them understand that a busted IPO in the traditional market is a disaster, and you don't want that in a token market. So I think, for the way that you have to think about token investments is your sizing, your valuation, and when liquidity is there, and hopefully you've created that alongside your founder, you can take it. And again, if that liquidity evaporates, which it has time and time again in cycles, you want to make sure it's a strong enough project to retain and sustain throughout the cycle. I mentioned this in the back, in the back room, but example of this was the previous cycle we had in my old firm, not my current, so don't jump on my marks. We had invested a small check into a gaming asset that shortly thereafter we had 20% liquidity. We worked with market makers, got listings, we sold out the 20% at 880x, managed the liquidity well enough that it continued its upward trajectory. All right, so we didn't crash the market. You do some off exchange, some on exchange, some structured deals. And, fast forward 3-4 years later, it's still a 40x from the original investment. So if you didn't get off your full position back then, you can still sort of trickle out of it as long as you got a great valuation on a high quality project and you've helped them manage throughout the liquidity cycle.
I mean, I think it's a little bit of a hot take when I talk to crypto people, but I actually think in the
You're
long
a crypto person.
No, I'm an venture investor. No, I do think though that there's in the longer run the supply and demand dynamics of tokens are just changing dramatically. I think there was a very long period of time I could say at BitGo when I was there, we had a 20% market share of all on-chain Bitcoin transactions. $4 trillion of Bitcoin came through the platform in the 4 years I was there, and we launched more than 20 layer 1 blockchains in our wallet platform from the Genesis block. I think now when I got there, there was maybe 2,000 tokens. Now there's over 22,000 cryptocurrencies and growing every day. And so I think when you start to think about liquidity from our perspective, we're really focused on backing what we think will be category kings. We're not just indexing. If you look at a lot of funds, they're just really index funds on early stage token projects. I think for us, how we think about liquidity is back what we think will be fundamentally category kings, game changers, and if you're in those names, there's going to be liquidity. Good example of that for us is Miston Labs. The SUI blockchain, we're very bullish on what they're doing. We think it's going to be a long-term leader, and there'll be plenty of liquidity for us to get out.
Same framework I listed across both types of structures. It's consistent for me.
Awesome. I guess today, after the election results, the market's quite good. But overall, in 2024, all the CEX, Binance, or major Coinbase exchange listing tokens have been performing mainly downwards, with most of the highly anticipated, big layer ones or high FDB billion plus market cap projects have been underperforming than what community or the venture funds have been expecting them to perform at. Based on these kind of trends and changes, especially around like infrastructure projects that's been not performing as well as we had anticipated from the industry side, have you guys shifting some of the investment strategies? How do you think about exits of different categories? And is there a certain type of ideal terms that you guys go for in seed or A stage of token investing within your firm?
So this is around the high FDV, low float narrative. One, the most you can do as an investor is just look to secondaries, particularly if you don't think they're going to grow into their valuation. That's the most obvious path forward. But what's actually shifting is how companies are approaching a high FDV, low float because, okay, a little history lesson. So FTX and FTT actually pioneered, this is an artifact from FTT and FTX times, they actually pioneered high FDV, low float. And what that means is you launch a network, launch a token, you hold the majority of your own token in your own treasury and have 5% floating or so, and then you're easily able to manipulate market price, right? And you can launch to whatever it may be, like a multi-billion-dollar valuation, and easily kind of manufacture this high growth story. And it's not reflective of what true demand for the protocol looks like. So you can have a multi-billion-dollar protocol and have like just a few users, and obviously we're being facetious, but that is what you're ultimately looking at. And what happens in that instance is unsophisticated, particularly retail, but just buyers in general are buying into what they think is a successful product and has earned its multi-billion-dollar valuation, hold that asset, and then at some point it's down only. And that leaves scar tissue, leaves a bad mouth in people's, it's not overall net positive. And there's been enough time where enough people have been burned that it's become a transparent meme. People know what's going on, and companies are starting to bend to the will of the user in that they are giving more to their community in terms of the allocation they set aside. They're being more transparent around their unlocks. Some of them are making them milestone based. If you've seen some of the more recent Solana projects, the infrastructure is powering that. So on the investor side, the most you can do in that instance, if you aren't the lead and aren't going to go in and change the language or have a talk with your actual founders, is to look to secondaries. But really where you're seeing the shift is not on the investor level. You're seeing it, it's great, like free markets are kind of doing their thing, and that the companies are actually responding to what users want to see, and that's more transparency, and launching at lower FDVs so that users can buy in and grow with grow their own value, their own net worth as their companies or protocols that they buy into do well and grow together.
Yeah, they're misguided, busted IPOs is what it comes down to. I mean, this is just, there's no natural buyer for another protocol at 6 billion FDV. So
especially when it's listing every other week.
And who are the bankers of our industry? They're venture capitalists who say, listen, we need you to come out at this market so we can mark our books, raise our next fund, and then we'll deal with liquidity later on. We'll have a great mark, and then we'll deal with distributions if we can get it. And so I think like the reality is, I think we as a venture industry, and I think my panelists up here, I think are genuine in that we look at it as early stage venture. You give them what they deserve from a valuation standpoint. You allow the rest of the market to make money alongside of you. Now, if you're not willing to do that, there's a lot of different alternatives these days. There's a lot to do in the secondary markets. There's a lot of spivvy secondary brokers that operate in the shadows, and then there's real institutions that are willing to put in structured hedges in a way that allow you to lock in a certain price on a part of your position. And the more big capital pools support these desks, so the more banks have their own crypto native trading desks, the better priced those hedges are. And they have gotten a lot better over the years. And so now you have this ability to lock in what is a meaningful, mark on your portfolio out of what you can effectively distribute and trade out of that asset.
I think going back to your original question around strategy, again, I come back to what I said earlier. If you look at what happened from 2018 to 2021, many of what are now the biggest funds in crypto made a ton of money and a lot of returns for their investors by being in very early stage projects that became Solana, Avalanche, go down the list of those things. I think there's a sea change coming. I think when you look at what is happening in the token space, I mean, we've looked at 3,000 deals in our fund, maybe invested in 35. We could easily weed down so many projects by just asking them, why are you using blockchain? And what does your token even do? What is the value of it? A lot of times the conclusion we come to is just most of this is vaporware. And so when we think about what our strategy is, to the extent we can be early in fundamentally game-changing projects, i.e. Mist and Labs and Sui, we'd love to participate. The reality is we think in the very long run, the most interesting investment base in this asset class right now is not RWA's real-world assets, but RWU's real-world use cases. These are companies that are using blockchain to fundamentally disrupt huge industries, generate real revenues, have earnings, real founders building real things. And we're spending a lot of our time focusing there, and we think these are going to be some of the most valuable companies in the next decade.
Vic, I'm going to ask you the same question because people won't know this because he's asking questions, but Hash is one of the most prolific investment firms in the industry. They have done extremely well over the years, both for themselves and their investors, and are a key part of the crypto industry. So
thank you, Michael.
Your own question, back to you.
Yeah, I think the general fund strategy on exit has been evolving a lot. And, to be honest, we started as 3 engineers and founders starting investing 7 years ago. And our way of returning 1000x on certain portfolios, such as X Infinity, we were first investor. We were very naive that we gotta be founder friendly and we just hold long term. Like we're the last one to exit. We're gonna go along with them. And usually those were like a vintage of like 18 and 19, and those didn't perform at all at the listing time frame, but they all went up as the market kind of picked up, just like how Solana, picked up the community and the whole maniacs behind the price action. So that worked really well for Hashed because we are naive, founder friendly, we hold for long term, and we ride the wave together. But now in this market, as Suna mentioned, the low float, in high FDB market, investors also cannot be just naive and hold long term to realize DPI and return. So we're also taking quite active, more aggressive approach on watching the market and realizing return as we minimize the impact on the liquidity or the price action. So I think it keeps changing per cycle, but we're learning as we go as well. Every cycle is very different dynamic, and there's different players coming in, whether that's market makers or new exchanges or new form of token launches. I guess as we wrap up, I want to touch on what were some of the highest performing categories or portfolios of your funds, and is that still gonna be your kind of future high potential bets, or is it kind of shifting? What are you looking forward to in 2025?
I'll go quickly. I think, again, we're really excited about seeing the emergence of real-world use cases. A good example of this for us is our portfolio company called Gunzilla Games, which we talk about a lot. This is a company that's done a really good job building a AAA video game. It's the first ever video game on PlayStation and Xbox, where 100% of the in-game assets are actually living on the blockchain. This is a sector, gaming specifically, which has seen a lot of capital inflow. If you actually look what's happened over the last 12 months, it's become a lot harder for gaming companies to raise capital. A lot of that is, I think, people are waiting to see, is anybody actually going to build something that people want to play? Does blockchain actually add value? If you take a look at what's going on with Gunzilla, they launched maybe 3 or 4 weeks ago. They've already got 10 million wallets that have been installed and downloaded. This is a PlayStation and Xbox game where I can send digital assets from a wallet on my phone to someone anywhere in the world and it shows up on their console. I think this is a game changer, and in terms of something in our portfolio we're excited about, I'd put this at the top.
I would say generally just you kind of want to look for what's not researched or covered today. So I mean, like the early days when we were investors in Solana, no one thought about high throughput chains. That was not really a thing at that point in time. Gaming, we were early and alongside you, or maybe around after you, in Axie and YGG, and those ended up being some of the biggest portfolio returners for my old firm. I still like gaming today. I would say, again, it goes back to finding I like what you said, category killer, but a founder that is a killer, that is a category killer. Work with them early on. Again, valuation really matters. The difference between getting in at a 10 million cap and a 20 cap is more than you could possibly fathom. And I think that's incredibly important. One sector that I think is very undercovered, in particularly in the US, is intellectual property and IP-Fi. I think that's going to be, it's an enormous potential sector of the industry if it takes off, and it's a big if. But I think it's one of the categories that could be a monster in the next cycle.
Yeah, so categorically, we've seen major breakouts across both infrastructure and consumer, so it doesn't actually weight one towards the other, though a lot of investing activity throughout the bulk of the bear market has been in infra. We've seen things like on the gaming narrative, like we're investors in Pixels. Pixels has over, like we talk about real use cases, real users, like over 1 million users. They have 1 billion, I think their FDV was roughly around 1 billion. They are they account for 95% of activity right now on Ronin Chain. So it's been incredible to see that kind of traction from a game. But when you look forward in terms of narratives that would be interesting to track, is crypto products, and this could be a consequence of the maturation of the industry, are starting to mirror some general tech narratives and some general tech products narratives as well. And so if you think about what the last couple years has been, it's largely AI. And in Silicon Valley, the next iteration, of course, is a substantiation of AI, which is robotics. We're giving the brain a body. And if you're looking at some of the more nascent categories, I think there are about 5 right now in crypto. It's the intersection of crypto and robotics. I've had a founder from MIT and another founder from Yale who've founded their own robotics companies before, didn't have much interest in crypto, realized that one critical piece to the robotics space in terms of egocentric vision data, we don't have time to go into it today, but you can look it up afterwards if you want. They have to do it through crypto. It's like actually the most efficient, streamlined way to do it. And that is one of those emerging nascent categories that you should have on your radar.
as a previous robotics engineer myself, would love to learn more about that afterwards. Thank you so much for joining us. We had a four-seller, VC joining us, sharing about how we return DPI and also how we navigate the early stage investing. Thank you so much, everyone.